I don't think it's useful to look at the gold mining industry as a group. I have said before, traditionally it's been poorly enough managed, and there's been enough variability in commodity price that if you invest in the sector, you go broke either quickly or slowly. If, however, you do as I've done over 50 years, and I'm not trying to say I haven't made some horrific mistakes, but if you have done as I've done, which is to say invest countercyclically and invest on the basis of real, true securities analysis, not merely looking to companies as a proxy for upside in the commodity price, this is a very good business. And the fact that it's cheap makes this a good entry point.
In this discussion, Rick Rule emphasizes a shifting global landscape where the dominance of the US dollar diminishes in importance. He suggests that geopolitical tensions and the weaponization of the dollar compel countries to seek alternatives like gold for international trade. Rule also highlights potential mispricing in gold mining companies such as Barrick and Newmont, citing their strategic moves and the market's misunderstanding of political risks. His insights underscore the enduring demand for gold amidst geopolitical uncertainties.
The first is that I think that we are coming into a period where, while US dollar hegemony does not end, it becomes less important. I think the export of US political will through the weaponization of the US dollar and the weaponization of the US securities markets means that countries outside the US increasingly have to buy gold to trade with each other outside the US dollar. I don't believe that the BRICS currency will ever get off the ground because I don't think those companies trust each other. Increasingly, they don't trust us either. And I think that gold will, in terms of international trade, regain its status as money. I don't think that the Chinese are buying gold because they want to. I think the Chinese are buying gold because they recognize that they have to. They don't want to settle trade in Russia with rubles. The ruble is a worse floating abstraction than the US dollar. People who buy crude oil from Nigeria certainly don't want to receive naira. The naira seemed to decline at 25% compounding year in, year out. They want to do business because they have to outside the US dollar because the US government is making them do business outside the US dollar. And the only medium of exchange that has some price stability and some liquidity is gold. So I personally see, as long as the United States continues to pursue its obnoxious foreign policies, that demand for gold will be strong. Let's look at a couple of the producers and let's talk about the decline. Barrick was a horrible underperformer for 10 years. And it's viewed by institutional investors historically the same way that they would view AIDS. Meanwhile, the company has made remarkable efforts to become a better company. But part of those efforts has been that Mark Bristow has pursued assets where they are as opposed to where the market would like them to be. So his moves into places like Pakistan have, from the market's point of view, led to the perception of increased risk. If you look at the success that Bristow had before coming to Barrick at Randgold, which emerged into Barrick, what you will see is that he is remarkably astute in doing business in places that other people would define as risky. So I think the market is mispricing the political risk around Barrick. It is true that Barrick will have trouble maintaining production if they don't increase their development spend and increase it fairly rapidly. In the case of Newmont, I think what you have is Newmont acquired Newcrest. There were a bunch of holders of Newcrest who owned Newcrest because they were looking for a transaction. When they got the transaction, they sold. And they sold in Newmont shares, which is what they acquired. If Newmont is successful doing what they say they're going to do, which is focus on their tier one assets and sell their tier three assets and some of their two-tier assets so that they can improve their balance sheet and improve their ability to focus on their tier one assets. I say if, I'm not saying they're going to do that, but if they do what they say they're going to do, Newmont will really surprise people in the next 5 years. So I view the sell-off in Newmont as very much a one-off event associated with the acquisition of Newcrest, which I believe, by the way, was a good thing. I think it's important, I think, that you need to look at these companies one at a time. I don't think it's useful to look at the gold mining industry as a group. I have said before, traditionally it's been poorly enough managed, and there's been enough variability in commodity price that if you invest in the sector, you go broke either quickly or slowly. If, however, you do as I've done over 50 years, and I'm not trying to say I haven't made some horrific mistakes, but if you have done as have done, which is to say invest countercyclically and invest on the basis of real, true securities analysis, not merely looking to companies as a proxy for upside in the commodity price, this is a very good business. And the fact that it's cheap makes this a good entry point.
Continuing his analysis, Rick Rule delves into the dynamics of the silver market, emphasizing its historical lag behind gold in precious metals bull markets. He explains that while gold typically establishes the narrative, silver tends to follow suit, but with greater intensity, leading to significant upside potential for silver stocks. Rule predicts a potential surge in silver prices and equities in late 2025 or early 2026, based on past market behavior. Despite acknowledging his tendency to be an early buyer, Rule underscores the importance of timing and market realism, cautioning against overly optimistic predictions and emphasizing the need to adapt to the current market conditions.
My experience in silver has been that it lags gold, that in a precious metals bull market, gold leads and then silver follows, and usually by some time. What happens, however, is that after the narrative in a precious metals bull market is established by gold, when silver does move, it moves further and faster. And the real jackrabbits are, of course, the silver stocks, the last movers. Silver has to move before the silver stocks move. When the silver stocks move, or when the narrative extends to silver, what seems to happen is that the combined market caps of the real silver companies, not the little penny dreadfuls, not the silver pretenders that are looking for silver but don't have any, but rather the development stage companies, the advanced explorers, the producers, the senior producers. There is not enough market capitalization in the silver space to handle the influx of generalist money when it comes. And the upside explosion that you get in silver prices, silver equities prices, I've seen it happen 3 times in my career, is truly staggering. Although I don't expect this event to occur for a couple of years, because I have 3 prior examples, I can't resist beginning to buy those stocks now. There's a flaw in my character, which means once they're up off the bottom, I'm psychologically unable to buy them. I'm a perpetual cheapskate and a credit guy to boot. So I have to be early, or else I miss the move entirely. What that means is that I am assembling a basket of silver equities with the view that I get rewarded in late 2025, early 2026. Something which many people don't have either the psychological or the financial ability to do. Well, if you follow the logic that it's unlikely that you get a major move in the gold price without a move down in U.S. interest rates, without the Fed capitulating, and you believe that gold has to lead silver, you consign 2024 to be a consolidating rather than a rising year in gold. And by nature, if you think that silver is delayed, that takes that trade out to 2025 or 2026. If we have some exogenous shock to the system, if we have some sort of liquidity panic, and the Fed reacts the same way it did last time by opening up the spigots, then all bets are off. I think you'll see this thing take off in the same way that gold took off in 1975. Remember, however, that I said if the current trends stay in motion, I suspect that we'll have a lackluster year, a sideways year. I'm buying nonetheless. Things are cheap enough. And in my experience, well, Bernard Baruch once said, the only investor who absolutely bought the bottom and sold the top was a liar. It didn't happen. And I suggest that market timing that assigns a higher value to anything than being approximately right is a joke. You can't do it, particularly in capital-intensive cyclical businesses. You have to remember the dictum that which is inevitable is not necessarily imminent. The fact that you wish it was doesn't matter. Wishes aren't prophets. You have to pay attention to the markets as they are, not to the markets as you would wish them to be.
In today's discussion, Rick Rule provided valuable insights into the evolving dynamics of the global economy and the precious metals market. He highlighted the diminishing importance of US dollar hegemony, suggesting a resurgence of gold as a medium of exchange in international trade. Furthermore, Rule discussed the potential for silver to outperform gold in bull markets, emphasizing the opportunities within the silver equities space. As we navigate through these trends, it's essential to remain informed and adaptable to market conditions. Thank you for joining us today. Don't forget to subscribe to our channel for more insightful content, like this video if you found it valuable, and share your thoughts in the comments below. Your feedback is invaluable to us. Until next time, happy investing.